Welcome to Doc Does Financial History, where money, power, and history collide, and nothing is ever as simple as it looks. You walk into a conference room on Wall Street in 2007. The carpet is pristine, the coffee is strong, and the hum of computers fills the air. You're not a junior analyst. You're someone who knows money, big money. And right there in that room, decisions are being made that will ripple across the globe. On the table in front of you are stacks of mortgage-backed securities, bundle home loans, sold to investors around the world. Everything looks solid on paper. Housing prices are rising, people are paying their mortgages, and the financial models say this is low risk. But you notice something unusual. Some of your colleagues aren't just holding these securities, they're betting against them. They're buying what's called credit default swaps. In simple terms, these are insurance policies that pay off if the mortgages fail. You realize that while the world thinks the housing market is safe, someone in this room is quietly preparing for disaster. That someone is Goldman Sachs. And the strategy they're about to execute will make them billions and spark one of the biggest controversies in modern finance. How it started, the housing bubble. In the early 2000s, the U.S. housing market was booming. Banks were giving out mortgages to almost anyone who asked, including people with shaky credit. These were called subprime mortgages. To make money, investment banks like Goldman Sachs would bundle these mortgages into mortgage-backed securities, MBS, and sell them to investors worldwide. Pension funds, insurance companies, even foreign banks bought them because they were told the risk was low and the returns were high. On paper, it looked like a win-win. Homeowners got loans, banks made fees, investors made money. But underneath it all, the system was fragile. Many of these homeowners couldn't actually afford their payments long-term, and housing prices were being artificially inflated. Goldman Sachs saw the danger. But instead of warning investors, they started using derivatives called credit default swaps, CDS, to bet against the very securities they were selling. Essentially, they were saying, we think this market will crash, and we're going to profit when it does. The mechanics, betting against their clients. Here's how it worked. Goldman Sachs would create a synthetic mortgage-backed security, a product that mirrored the risk of a real bundle of subprime mortgages. Then they'd sell this security to investors as a high-return investment. Simultaneously, Goldman would buy credit default swaps on the same securities. If the housing market collapsed, the value of the MBS would plummet, but the CDS would pay off massively. To put it simply, Goldman Sachs was selling risky investments to clients while secretly betting that those same investments would fail. And when the market collapsed in 2007 to 2008, it did fail. Homeowners defaulted on their mortgages. Mortgage-backed securities lost almost all their value. Investors lost billions. Goldman Sachs. They made about $3.7 billion from shorting the very assets they had sold to clients. Who lost and who gained? Let's be clear, this wasn't just a numbers game. People lost their homes. Pension funds lost billions. Cities and towns around the world felt the ripple effect. Goldman Sachs executives, on the other hand, walked away richer than ever. They had hedged their bets perfectly. While their clients were burning, Goldman Sachs' proprietary trading division was collecting massive profits. And it wasn't only about the CDS trades. Goldman Sachs also benefited from bailouts and government interventions. When Lehman Brothers collapsed in September 2008, it triggered a global panic. The Federal Reserve and U.S. Treasury stepped in to stabilize the system. Goldman Sachs, which had converted from investment bank to bank holding company just before the crisis, gained access to emergency funds, liquidity, and additional credibility, while other banks floundered. The Abacus deal, controversy. One deal that became emblematic of Goldman's strategy was the Abacus 2007 AC-1 transaction. This synthetic CDO, collateralized debt obligation, was sold to investors for $1 billion. But there was a catch. The hedge fund Paulson and Company, led by John Paulson, helped select the mortgage securities that went into the CDO. And Paulson was betting against it. Investors were not aware that the CDO had been essentially designed to fail. When a housing market collapsed, the value of Abacus fell dramatically, and Paulson and Company made $1 billion, while investors lost almost all their money. Goldman Sachs earned $15 million in fees from arranging and selling Abacus. While this might seem small compared to billions in losses, it highlighted the ethical dilemma. Goldman was profiting from creating products they knew could fail. How Goldman Sachs framed it. When the SEC sued Goldman Sachs in 2010 for fraud over the Abacus deal, Goldman argued that they had disclosed the risks to investors. The company said that the investors had all signed disclosure forms and had access to detailed reports. But the public perception was different. Critics argued that Goldman Sachs had engineered a product to fail for someone else's gain and then sold it to unsuspecting investors. In April 2010, Goldman Sachs agreed to pay $550 million to settle the SEC charges without admitting wrongdoing. It was one of the largest penalties ever for an investment bank, but compared to the billions they made during the crisis, it was barely a dent. The bigger picture, Wall Street incentives. Goldman Sachs' strategy wasn't unique. Many Wall Street banks were profiting from subprime mortgages, credit default swaps, and other complex derivatives. But Goldman's approach stood out because of the scale and sophistication of their bets against their clients. This was a period when Wall Street incentives were aligned around short-term profit, not long-term stability. Traders and executives earned massive bonuses for deals that performed well immediately, regardless of the long-term impact. The result? A financial system built on fragile assumptions and risky products that few fully understood. Government and public response. The 2008 crisis prompted widespread outrage. Taxpayer money bailed out failing banks through TARP, Troubled Asset Relief Program. Goldman Sachs received billions in emergency support, while the average American faced foreclosures, unemployment, and lost retirement savings. Senators and journalists repeatedly questioned Goldman Sachs executives. Famous lines like, "Who is your client?" became symbolic of the mistrust between Wall Street and the public. Critics accused the bank of putting profit over ethics, essentially profiting from the suffering of millions. Despite this, Goldman Sachs' reputation on Wall Street remained strong. Many clients continued to invest with them, and the bank quickly rebounded in the years after the crisis. Lessons from the crisis. So, how did Goldman Sachs profit while the world burned? Betting against their own products. By using credit default swaps, Goldman could profit when securities failed, access to insider information. Their analysts and traders understood the fragility of the housing market before the public did. Complex financial engineering. Products like synthetic CDOs allowed them to create exposure to both sides of the market. Government protection. By converting into a bank holding company, Goldman gained access to emergency funds during the collapse. Risk-reward. Incentives. The structure of bonuses and compensation encouraged high-risk strategies with massive potential upside. The result? Billions in profit while investors and homeowners lost everything. The human cost. It's easy to talk in numbers. $3.7 billion in profit, $550 million in settlement. But behind those figures were millions of families who lost their homes, retirement funds, and trust in the financial system. Entire communities were destabilized. The unemployment rate in the U.S. spiked, and people who had spent decades saving for their future saw it evaporate. Meanwhile, Goldman Sachs employees continued receiving multi-million-dollar bonuses. This dissonance fueled a public backlash that would later become part of the Occupy Wall Street movement, where the slogan, "We are the 99%," captured the outrage at economic inequality exacerbated by the crisis. Reflection. Could it have been avoided? Many experts argue that the 2008 crisis was predictable. Goldman Sachs and other investment banks had access to data showing the housing bubble was unsustainable. Regulators had warned about systemic risk. Yet the combination of market incentives, poor oversight, and complex financial products created an environment where banks could profit even as the world economy collapsed. Goldman Sachs' story illustrates a deeper problem in modern finance. When incentives and ethics misalign, the consequences can be catastrophic. The aftermath. In the years following the crisis, Goldman Sachs returned to normal operations faster than most. They paid fines, yes, but they also grew stronger. They diversified into new markets, expanded globally, and maintained a dominant position in investment banking. Meanwhile, financial reform efforts like the Dodd-Frank Act tried to address systemic risks and increase transparency, but critics argue that enforcement has been inconsistent. And the question remains, if another bubble forms, will the system behave any differently? Goldman Sachs profited from the 2008 financial crisis not because they were lucky, but because they engineered strategies that took advantage of the fragility in the housing market. They bet against their own products, leveraged sophisticated financial instruments, and navigated the crisis with skill, while the average investor and homeowner suffered catastrophic losses. It's a story about money, power, and influence. About how a single financial institution, armed with information and risk-taking, can turn a global economic disaster into billions of dollars in profit. And it's a story that reminds us why transparency, regulation, and ethics in finance aren't just optional, they're essential. If you want to understand the deeper forces shaping the world economy or how Wall Street operates behind the scenes, keep asking questions, dig into the data, and stay informed. Because the lessons of 2008 are still relevant today. Thank you for watching. If you want to know more about the stories behind global finance, follow our reporting and dive deeper. Leave your thoughts in the comments below. Share this video if you found it informative, and consider subscribing to our channel. Until next time, stay curious and stay aware.